We are good to go ahead. So welcome to Navigating Debt Financing and Tax Credit Strategies in the Games Industry. A catchy title, I'm sure you'll all agree. My name's Piers Hunt. I run a debt financing business called HH5. I'm going to sit here and talk to you today about the debt financing element. And Nick Johnson is here from the Effect Group, who are specialist accountants in the media sector, who, after I've spoken, is going to talk to you about tax credits and tax credit strategies. So without further ado, we'll begin. So what is debt financing? What are the differences between debt financing and equity financing? One of the key things to take away from today is really that debt financing allows you to raise capital or improve cash flow without giving up equity. And that's really one of the key points. I can't emphasize that enough. So the benefits here are you obviously keep full business ownership. There will be capital repayments with interest, but we don't expect dividends or a share of future returns. We will require security or a charge of some kind, but that falls away once the loan is repaid. And lastly, I'm afraid you don't get access to investor knowledge, but as I said, you're obviously not giving up equity in return for that. We've touched upon this. So examples of things that can be cash flowed or debt financed, which is effectively the same thing, is publishing and or development agreements, contracted payments, and tax credits. I would say tax credits and publishing and development agreements are the most common forms of collateral we tend to lend against. The debt financer will lend you these funds minus interests and costs. Mainly those are legal costs, our lawyers' costs. When the funds are received from either HMRC or from whoever your publishing or development contract is with, you then repay those funds to the financier to pay off the debt. Why use debt financing? Well, we've touched on this already. The key thing is a cash flowing future income streams creates liquidity, improves your cash flow without having to give up equity in your business. So this will allow you to speed up game development, allow the business to reach the next development milestone. Perhaps you have a development contract, but you haven't got sufficient funds to get to that next milestone. Well, you can borrow that money in advance from us, and that'll allow you to then make it to the next milestone. Similarly, you can grow the development team, or perhaps start porting onto a new platform ahead of schedule. If you're getting some buzz about the game and your things are going well, you might want to actually start that process of porting to a new platform as soon as possible. And we can help with that by advancing you funds against these future income streams. Or on a more sort of negative end of things, if you're running low on cash, we can help keep the lights on until the game is released and generating revenue. And as I said, all of this without diluting any equity ownership. So you keep 100% of your business. So tax credits we've talked about. Tax credits are one of the most common elements being cash flowed. The key piece of collateral here is an opinion letter from a reputable media accountancy firm. Obviously, the Effect Group, represented by Nick here, is one such firm. There are only probably 8 or 9 firms in the UK that a debt financier would accept an opinion letter from. So it is a very specialist area. And the opinion letter is effectively the accountant's opinion as to the level of the tax credit that's going to be generated. And the opinion letter here is addressed to the debt financier as well as the games producer. So that means that the accountant owe us, the financier, a duty of care as much as that they owe the producer. And that allows us to use that letter as the key piece of collateral for the loan. There is often, or there can be, an additional cost to this letter because you're owing, the accountant rather, is owing a third party a duty of care as well as yourself. Obviously, that increases their liability, and so they may charge you more for that. So I would always suggest when speaking to games producers that when you're getting your accountancy fees negotiated, always make sure an opinion letter to a third party is included, because it won't really change the cost of the accountancy fees day one. But if you have to go back at the 11th hour and ask your accountant for an opinion letter at that point, they will tend to charge you an extra fee. We would normally only lend up between 80 and 90% of the tax credit. Obviously, that's just to give us a bit of a buffer in case the anticipated spend is lower than expected, to make sure that we are able to recoup the funds and our investors to get their money back. The loans against our tax credits will normally entail a letter to HMRC asking them to pay the tax credit directly to the lender. So in this instance, HH5 would advance funds to the games producer. But when you filed your tax return and the tax credit is being repaid, you ask HMRC to pay us back directly, which obviously reduces our risk, which hopefully means we can charge slightly less on the interest. So other elements that can be cash flow, we've touched upon, obviously, development contracts and production contracts. Against a publishing or development contract, the funds normally paid directly to the games producer. So you then have to pay those onto the debt financier to repay the loan. There'll be, as I said, we can do a number of milestone payments, which means we can do multiple drawdowns and multiple repayments. So effectively, you might want to borrow, obviously you want to borrow the smallest amount of money for the shortest period of time. So what we can do is stagger your drawdowns and your repayments to ensure you're only borrowing money for the minimum amount of time. One thing to flag with regards to this kind of debt financing and these kind of contracts is that there may well be a cancellation clause in the contract. Now, as a debt financier, obviously we have to assume a worst case scenario. So if there is a cancellation clause in the contract, normally that comes with a cancellation fee or charge. So we can cash flow that amount of the contract, but we won't be able to cash flow the full value of the contract because we have to assume a worst case scenario and assume that the contract will be cancelled. So in the past, what we've done when we've had that problem is we were working with a producer and they also had some tax credits coming their way. So what we were able to do is effectively lend the full value of the development contract, but we took rights over their tax credits, which in addition to the cancellation charge was sufficient collateral for us to effectively have the right amount of collateral for the loan. And then as that loan was repaid, we released our rights over the tax credits back to the producer, allowing them to then borrow against those tax credits again in the future. But that's just something to flag. As each milestone hit, the developer pays out and the borrower obviously then pays us back the debt. Moving on to the next slide. Costs. So obviously one of the key things is how much does this all cost? So the cost of the loan is usually structured into an arrangement fee, an interest reserve, and legal costs. The arrangement fee can range in size, but generally between 1% and 5%. We'll go into this on later slides. The interest reserve is simply the amount of interest for the number of months of the loan. So normally the interest is calculated on a per month basis. So if, for example, you had a 6-month loan and the interest was 1% a month, the interest reserve would be 6%. And lenders' legal costs, these can range in size enormously. The size of the loan does tend to impact the legal costs a little bit. Obviously, one might argue that it shouldn't, but inevitably it does. We can do tax credit loans for as little as about £5,000, but they can be as much as 15 to 20 or even more if it's a really huge tax credit claim. So a lender will also need to take extra forms of security. So obviously we have the opinion letter, that's the key piece of collateral for the loan as far as a borrower, as a lender is concerned. But we'll also need to have what we call a shortfall position at the top of the fiscal waterfall. Before I go any further, it just should be noted that both of these elements only come into play if the funds are not returned from the expected revenues. So obviously we would expect the monies to come back from the tax credit or from the development or publishing contract. If they don't, or if there's a shortfall, then these come into play. So effectively, there's a shortfall position, which means that if there is any money outstanding, HH5 then moves to the top of what we call the fiscal waterfall, which means any revenues created by the game are paid directly to HH5 until the loan is repaid. But again, as soon as the loan is repaid, that position falls away. And then the second thing is a charge against the game or company. This is effectively, to be quite blunt, to effectively allow us to stymie you taking the game to market. So if you haven't repaid us all the money we're owed, we have a secure charge against the company or the game, and we can effectively therefore control the IP and stop you going to market. We are a debt financing business. The last thing we want to do is try and take a game to market. But at the same time, we have to have that ability to stymie you doing that if you still owe us the money. With regards to the charge, one thing should be noted is that if the game has been developed through an SPV, we may well look to take security against the parent company as well, as obviously we all know SPVs can be rolled up relatively quickly, so it's just something to bear in mind as well. And as I said before, the situations only come about if the loan is not repaid from the expected revenues. So the next slide, so these are indicative heads of terms, pretty standard. These are kind of generally the elements that we need to agree before we can instruct lawyers. So in this instance, assuming a tax credit or a loan here of £500,000, we'll assume that let's say for the moment that's 90% of VGTR. And in this instance, so I can show you the flexibility, 50% is being repaid by December this year, 50% next year. The arrangement fee, 3%, relatively standard. Interest rate per calendar month, 1.25%. Interest reserve, slightly more complicated here because effectively, because it's half is being repaid after 4 months, The second tranche is obviously at half, it could be at half the rate of the full loan, or yeah, it's easily calculable. So that takes us to about 8.75% in total, plus the 3% arrangement fee will be your total interest costs. Legal fees, yeah, £4,000 to £5,000 plus VAT. Default rate of 3% a month. So going back to what I was saying, if the loan hasn't been repaid from the expected revenues by the end of the loan term, then any outstanding sums will accrue interest of 3% a month on them until the loan is repaid. That tends to range between 2.5% and 3% as an industry standard. As I touched on previously, first shortfall position, the waterfall, opinion letter made out to the firm, security over the project, and then we'd normally seek some kind of credit as well, maybe an EP credit or an associate producer credit, something to reflect the fact that we've obviously helped bring the game to market and help finance it. So what does that look like in reality in terms of actual costs? So if we assume a tax credit of £500,000, 90% of that is 450,000. So that would be the maximum amount we'd be prepared to lend. Going down to the interest reserve, we can see that the total interest would therefore be 11.75. So that's the 8.75 plus the 3%. And 11.75% of 450,000 is 52,875. Legal fees of 5,000 plus VAT obviously gives us £6,000. So therefore the loan would be 450,000 minus the total interest and minus the legal costs, leading us to a total advance of £391,125. So it's important to note here that effectively the interest and the legals are deducted from the principal before the loan is advanced. And so you can see here, quite interestingly, you've got a tax credit of £500,000, but very quickly you're only actually getting an advance of 391,000. So it's always worth being aware of that, so that drop down when you're planning your finances. The next slide is rather busy and has quite a lot of detail on it, but this is, once we've agreed those heads of terms on the previous slide, this is an indicative list of legal documentation required. And I grant you, it does look like there's a lot on there, but actually if you start looking through it, you'll notice that the vast majority of these things you will already have. And some of them may well not be relevant. So for example, under D, we've got lender board resolutions. You know, if your company doesn't have a sort of formal board in that sense, then obviously you're not going to need those. E&O insurance might be unnecessary as well. So this is a pretty comprehensive list. So it may well be not all of these factors are needed, but that gives you a good idea of the kind of documentation we'll need to see and our lawyers would need to review. What is a lender looking for? Well, we've established this clear collateral against which the money is to be lent, a clear time frame for repayment, and a clear path to repayment. We need to understand exactly how we're going to get paid back and when. And also very helpful is a proven track record of achieving. You know, if we're looking to cash flow milestone payments, well, it's always good to see that you've made at least 2 or 3 of those milestone payments already. And similarly with tax credits, if we can see that you have secured tax credits in previous years, then again, that's going to give us more confidence to proceed with the loan. Obviously, it's good to see a company with a good financial covenant strength in case there are any issues with repayment. Obviously, if the company's well financed, then we're less worried about you being able to repay the loan. A company with a reputation for clear financial dealing. Obviously, if we're lending you money, we want to know we're dealing with people we can trust. And then generally speaking, our minimum loan size, we can go a smidge under 100,000, but generally that tends to be the minimum loan size, because much below that, the costs of the loan, the legal costs, it almost starts to get to a stage where it's not really worth it for the producer, which is obviously what we're very, very conscious of. Lastly, these are a couple of games that we've helped finance. You may have seen some of these, but these are just indicative examples of some games we've worked on and some clients. And so, yeah, how can HH5 help your business? So what we can do is we can give you initial advice about what can and can't be cash flowed, as we've sort of outlined today. We can introduce you to accountants, such as Nick, who are experts in this area, and lawyers that also work very closely in this area. We can give you this indicative early stage costs and timings. So, you know, roughly, right, okay, if we've got this level of tax credit, what kind of advance are we realistically going to get out of it? We'll provide you then with the detailed quote. Once that's agreed, the lawyers are instructed, and once the legals are completed, we advance the funds to you, and the loan is repaid. One thing I should have flagged earlier is that because of the relatively onerous levels of default interest, I would always encourage a borrower to maybe have an extra month on the loan than they think they might need, because better to be in a position where you're potentially paying 1.5% extra rather than 3% extra, or even 2.5%. So just something to flag there. And one of the benefits of debt financing, it allows you, as we touched on earlier, to speed up game development, allow you to reach those development milestones, grow the development team, start porting to a new platform, and generally just allowing you to grow your business and move ahead in a way that you might not have been able to do otherwise. And of course, all of this without diluting your equity. I'm going to hand you over to Nick now. He's going to talk about tax credit strategies. And then at the end, we'll have some Q&A for everybody. Nick.
Thank you, Piers. Afternoon, everybody. Just wanted to say before I start on this that we've got quite a few video game development clients, and actually some of the most successful of them do use debt financing within their business models to bring their games to market in the best way possible and in a timely manner. So it's not just people who are struggling for cash. I know a lot of people are. It's also people who are doing well and producing high quality games. Anyway, on to me. I'm Nick from Effect Group. I've been providing strategic tax advice in the creative industries for almost 20 years. I know I don't look old enough. I've helped many game companies access the UK tax credit, which is really useful, including the two that Piers had on his slide, Pirate Queen and Tales of Kenzira. My company, Effect, has a good relationship with HMRC at policy level, having lobbied for the introduction of VGTR in 2014, sat on several panels about the implementation of the new expenditure credit, which I'm going to be talking about. This relationship, excuse me, also assists our clients as our games are generally approved by HMRC in about 4 weeks, which compares to the industry average of 3 to 4 months. And we've actually never had a claim denied by HMRC. So here we go. I've got 4 topics I'm going to cover in the next 15 minutes. They are the transition from VGTR to the Video Game Expenditure Credit, or VGEC, how VGEC compares to VGTR, one of the optimization techniques that we use, and whether VGEC would be more beneficial to your game development company than the old VGTR. So on the transition to VGEC, VGTR was introduced 10 years ago. In 2014. So we've had time to get comfortable with this. There were 345 claims in the last statistical year, with £189 million in cash paid out by HMRC. We're now transitioning to an exciting new video game expenditure credit. So here's a transition timeline with VGTR in blue and VGEC in orange. So if your company is better off under VGEC, it can already start making claims. Any spend from the 1st of January 2024 can be claimed under VGEC, with VGTR being the only relief available up until the 31st December 2023. Where your company is better off under VGTR, it can continue to claim on spend all the way up to the 31st of March 2027, provided the game development has started before the 1st of April 2025. Now, we have seen some clients thinking about this and planning to start development of their games before the 1st of April next year in order to maintain access to VGTR rather than being forced into the VGEC regime. Each company needs to be looked at on its own merits to work out whether you'll be better off under VGTR or VGEC. And actually, I'm going to look at that in my last slide today. So how does VGEC compare to VGTR? Overall, the transition to VGEC is a great thing for the industry, with a new headline rate of 34%, significantly up on the previous rate of 25%. But digging a bit deeper, it's a bit confusing, because there are actually 4 rates under VGEC. 34%, 27.2%, 25.5%, and 20.4%. So what are all these different rates? How do they compare to VGTR? And how much better off could you be under VGEC? I'm going to take you through a scenario quickly of a UK-centric company where UK core spend is more than 80% of your worldwide core spend. Here's a table comparing VGTR to VGEC. The 80% cap, which remains in place under VGEC as well as VGTR, means that where UK core is more than 80% of worldwide core, the headline rate of 34% is reduced down to a capped rate of 27.2%. There's then a notional corporation tax deduction, which only applies to VGEC. It was not applicable under VGTR, of 6.8%, which leaves us with an effective rate under VGEC of 20.4%, compared to 20% under VGTR. Doesn't feel very different, but the crucial thing is actually this notional corporation tax deduction of 6.8%. I'm going to be talking to you about that next. Before I go there, I should just cover the last of the 4 percentages. Please bear with me. So where UK core spend is less than 80% of worldwide core, the effective rate is 25.5, which is just the 34%. There's no 80% cap. So 34% less the 25% notional corporation tax, giving an effective rate of 25.5. So what is this mysterious notional tax deduction? It's caused a lot of confusion in the industry, so I'm going to explain this further before looking at how it can be used. The rate's always 25%, even if the game development company is loss-making or has profits of under 250K, being the large company 25% rate. And to recap the previous slide, for a UK-centric game with 1 million of core spend, the value of that notional corporation tax deduction is £68,000, the 6.8%, which is a big amount compared to your overall cash repayment of the 204,000. Works out at it works out at 33%. So it's a large amount, and you need to make sure that you can use it. If you can't make use of it, then what use is it? So how do we use it? The first way it can be used is the most simple. If you've got other profits within your game development company, because you've got one project you're doing which is independently financed, one that you're doing as a work for hire, which is giving you a good profit margin, then you can offset that notional tax deduction against the corporation tax payable on those other profits. You can do that in the current year or in a future year. The third and most abstract point on the slide here is where you can surrender the corporation tax deduction to a group entity to reduce their tax liability in the same period or a future period. Now, this makes sense where you're part of a large game studio and your parent company is very profitable, but your small development vehicle underneath it is just an SPV for that one project. But you might not have that structure. You might be an independent video game developer, like most of the clients that we work with, and they may not be able to use that notional tax deduction. It might be because they've got a long development period. It might be because they're reinvesting all of their profits they're making from games into new projects. It might be that the sheer size of that notional corporation tax deduction, which is £68,000 for every million of development spend, means that they don't have sufficient profits to cover it all. It might be that, in this slightly difficult climate we find ourselves in, that cash now is better than saving tax on future profits. In this instance, we've come up with a strategy to increase your VGEC cash benefit by 10%. What we do is we would design your structure so that a profitable UK company, which would be independent from yourselves, would take 75% or more ownership over your game development company. This wouldn't give them creative control over the project. They wouldn't be able to control the board. They would literally have a notional ownership of your entity. Now, as we saw on the previous slide, the game development company gets its £204,000 of cash repayment from HMRC based on £1 million of dev cost. It also gets the notional corporation tax deduction of 68,000, which it surrenders up to the profitable UK company. In exchange, the profitable UK company will pay your game development company £20,400, subject to commercial negotiation, for use of that notional corporation tax. You can't use it, they can, they're willing to pay you for it. And that increase in cash of 20,400 is 10% of the other cash benefit, cash repayment you'd receive from HMRC. Now, we use this strategy for some clients. It's certainly not suitable for everybody. In fact, it's only suitable for very, very few. We also use many other strategies, including period end planning, profit extraction techniques. I could go on to assist our game clients, but each client is individual, and that's how we treat them. So last and probably most importantly, will VGEC be more beneficial than VGTR to your company? Overall, the transition to VGEC is a great thing for the industry. And most companies will be better off because that headline rate of 34% is higher than the previous rate of 25%. We do need to be careful. One of the positive things about the expenditure credit is it's an above the line credit. It comes into your turnover. So it will improve your financials in the event of a future acquisition or when you're seeking debt finance from somebody such as HH5 and peers. Second benefit of the VGEC is that the subcontractor cap of £1 million, which applies to VGTR, where part of the process of designing, producing, or testing the game is outsourced to a third party, has been removed under VGEC. So companies who pay UK subcontractors more than £1 million will have no cap on that spend. A couple of negatives about VGEC is that some companies use special purpose vehicles, subsidiaries, to develop their games, and they charge that subsidiary an arm's length value for development services, which could be 8,000, 10,000 a month per person. Now, if this structure is justified, it could increase your repayment under VGTR by 25%, which is a greater uplift than the difference in the rates of 25 to 34%. And the new VGEC legislation and disclosure requirements by HMRC make it very, very difficult to continue to use this man-month rate or staff-month rate planning. Just to be even, I've got a second negative about VGEC, which is that EEA spend won't qualify for relief under VGEC. Now, this actually is probably the biggest one, because one of our clients has got a very small UK staff, so only about 20% of its spend on a game is on its UK staff, and it then has lots of contractors based in the EEA, mainly because they're cheaper. So if you've got a total dev cost of £1 million, 200,000 would be in the UK and 800,000 would be in the EEA. And in that scenario, under VGTR, you'd get a benefit of £200,000 in cash. And under VGEC, you'd get a maximum benefit of 68,000, which would actually only be 51,000 of a cash repayment. And the balance of 17,000 would be your notional tax deduction. So it's more than 3 times more valuable to maintain VGTR in that instance. Yeah, as with any change to the legislation, to these incentives, there will be winners and there will be losers. We work with our clients to identify which scheme they should be using, how they should be timing their projects, and optimizing their tax credit strategies. So a summary of both what Piers and I have been saying today is that debt financing is great because you can improve your cash flow without giving up equity. You can provide funds to keep the business going until game release. It allows faster growth and development, and you have clear and transparent costs with no investor interference. On tax credit strategies, VGEC is great. It's going to really help most companies. It's going to make us more competitive on the worldwide stage. It's going to bring in investment into the UK. We must consider each company's individual circumstances. It's possible to pick and choose which projects you have under VGTR and which ones under VGEC, if one is EEA contractor heavy, for example. And there are strategies that can be used to optimize your position. So I think I've spoken for long enough, but I know it's been a very quick run through by both Piers and I. So if you do need any clarifications on anything, then please feel free. Do we have a room mic?
I think they did.
Yeah, I think it's going around.
Thank you very much. Could you clarify how the interest reserve works on the debt financing? Because it looked like there was a 4% plus the monthly percentage figures. I'm just wondering.
Could you put the microphone a bit closer, sorry?
How's that?
Yeah, much better.
Miles better. Nice one. Thanks for the talk. Could you just clarify how the interest reserve works, specifically that initial figure, which isn't based on the monthly percentages? It looked like there was a 4% plus like 4 months of one.
Well, effectively, it's the rate per. So, for example, it's the rate per month for how many months the loan is. I think the confusion there may come on because there was a 2 payback dates. The way we'd calculated the second tranche of interest was we just effectively, because it was 50% that repaid at the first payment, 50% repaid at the second. We'd just done we'd cut the interest rate in half by 50%. What we could have done, of course, is to just cut the amounts in half by 50%. So yeah, and effectively, yeah, the interest reserve is just the amount of interest per month for how many months the loan is. But that may have been confusing slide.
Hi there. Hi, Nick. Quick one from me is, can you clarify where, if a company has claimed VGTR on a specific project, whether in future periods it can then claim VGEC on that same project?
Nice to have a client in the audience. Thanks, Neil. It's not a plant. So yeah, indeed you can. You can, I think in one of the slide with the transition from blue to orange showed that provided you have started development of your project before the 1st of April 2025, you can claim VGTR on that project all the way up until the 31st of March 2027. At that point in time, you're forced to switch for that project into VGEC. So what you'd have is if you had a 31st December 2027 accounting year end, you would claim the first 3 months of that accounting period under VGTR, and then you'd have to claim the second 9 months of that accounting period under VGEC. Good.
Hi there. I'm curious about future cash flows with respect to the uncertainty. So I understand the tax credits, you would be able to model those, I imagine, relatively certainly. But I'm curious about other cash flows. Can you incorporate those? And what can you actually model with some certainty to get a valuation on future cash flows outside of tax credits?
So effectively, it has to be to do what we do as a debt financing. It has to be a clear piece of collateral. So we cannot. What we have done in the past is, in the instance of a tax credit, if we're speaking to a developer and they've got their plan for the next year or so, it may be that they don't actually have sufficient funds today to create the expected tax credit for the next year. But we know that they're going to be getting revenues in terms of investment or revenue from the game. So we are prepared to lend against that projected tax credit, because we understand that even though they don't have the money to generate that tax credit today, it will be coming into the business. Obviously, we'll charge a little bit more for that than we would for a tax credit, but we know they have all the money to incur that credit. Similarly, with development or publishing contracts, I think as long as we can see that there is a contracted payment coming your way, and you can give us assurances that you will have sufficient capital to develop the game to that point, particularly with the input of the funds we're giving you, then that should be fine as well. It is slightly on a case-by-case basis, though. Obviously, we have to have comfort that the business is going to be able to get there. But as long as there's a clear path to that's a result, then that should be fine.
And I think just to add to what Piers is saying is that, and maybe to answer your question in a different way, is that user acquisition funding is quite prevalent in the industry, and that is not debt financing, because they don't just get repaid interest and costs. They get a rev share on your game. They get paid back plus a rev share on your game forever. So you're effectively giving up equity in your game for UA funding, which is a different business model to what Piers is doing. Obviously, it's less certain, but you're also giving away a huge chunk of your product.
Hi there, thanks guys, super informative. Not a question, I just wanted to flag that we're the games team from the certification unit at the BFI. So if anyone's got any questions about coming to get your game certified, you can come and talk to you guys, obviously, but come talk to us too. Thanks.
Hi, I have two questions, if that's okay, but I'll try and make them quick. The first one, I was wondering, is there any relevance for completely new businesses in this sort of model? Because it sounds like you need to have been around for a while to have earned those tax credits to be used as collateral.
No, so we will work with businesses when it's their first tax year, but of course we will still be reliant on the opinion letter from the accountancy firm. So as long as, I mean, obviously, and we will probably charge you more, if I'm being frank, than we would charge a business with a proven track record, which I don't think is unreasonable. But no, we will definitely lend to that. We also lend in the film and gaming, sort of the film and TV world, and we're often dealing with independent producers who, if you know anything about the film and TV world, have relatively little covenant strength, and that's being generous. So we are used to lending to people who don't have a proven track record. Obviously, the rates we charge will probably reflect that, but no, it's definitely something we can do. Is as long as we can get an opinion letter from an accountant stating that they, you know, that this is all expected.
Cool. And my second question was on the slide where you talked about being able to block the release of an IP.
Yes.
And also having the shortfall security where you get the revenue. I just wondered, are those two things contradictory? Because wouldn't you want the game to go out so you can get the revenue?
Very good point. No, so the security is the sort of the nuclear option. I have, you know, I probably shouldn't say this, but I've never enforced security. If I'm enforcing security, then we've all lost. Something's gone seriously wrong, and you know, it's not going to be a good situation. So the shortfall position is the initial position, and you know, hopefully we can continue to have a good relationship if there's a shortfall position, because you understand you haven't repaid the money that you owe us, and we're saying, well, look, we're just going to take the revenues until we're repaid, and as soon as we've got them, everything goes back to you, and we step out. But the security option is a sort of the backup position if, for example, even after the utilization of the shortfall position, we still haven't been repaid, or quite frankly, if you're just refusing to pay us, you know, just being completely bloody minded and saying, no, we're not going to pay you, then obviously we can ensure the security. But as I said, I've never enforced it. We will if we have to, but it is sort of the nuclear option, and we really don't want to be in a position to do that.
Thank you.
I'm back. Hi. More a comment than a query. It's possible to change your financial year end to have a shorter accounting period. So normally it would be a 12-month accounting period, and you claim your VGTR or VJAC on the 12 months. However, you can shorten your accounting period on Companies House to say 6 months, and therefore bring forward the cash flows from the VGTR into smaller chunks. I don't know whether you want to talk to that at all, Nick.
Neil, can you just come up here and do it for me?
That was my planned question for Nick, if there hadn't been any questions from the floor. So no, but thank you.
Yeah, you're absolutely right. Where you've got enough dev spend over a 12-month period, it's a lot. It's very. We have clients that make a claim every 3 months. Actually, it's about the minimum timescale. So you'd have a claim to March 2024, a claim to June 2024, a claim to September 2024, and a claim to December. Now, the cost of making a claim is preparing a set of accounts, which is about 1,500 quid, and then the claim itself, which you might, let's call it $2,000. So all in 3.5 grand. And if the time value of money, or it's cheaper than Piers' debt finance, is that the repayment that you get every 3 months is 100 grand plus, then clearly if you're only paying 3.5% interest over the course of the year on your money, then you're doing pretty well. It's cheaper than a bank loan. So that is used by quite a few of our clients, and it's all about the timing as well. You'd say, well, we've released the game, we've stopped our spend, we're now going to there's not going to be any qualifying spend after this point in time, because it's going to be on user acquisition, it's going to be on promotion, marketing, which none of that is qualifying spend. You'd say, well, let's cut off our accounting period immediately after that to get the tax credit back in as soon as we can, to repay the loan as soon as we can, to reduce our borrowing costs as much as possible. So yeah, thanks for that question, Neil. Much appreciated.
And am I right in saying you can bring your year end, shorten your year end as often as you like, but you can only push it out once every 5 years? Is that right?
Correct. Yeah, you can push it out once every 3 years to a maximum of 18 months. You can have a year end of a week, and we've never seen that, but it's theoretically possible.
Hi, I have a question for Piers, I guess. So you mentioned the valuation opinion that you get from the accountants.
The opinion letter.
Yes. The opinion letter, quite. So I'm trying to understand the significance of that, given you're essentially lending against, effectively guaranteed cash flows, whether that's from the government or semi-guaranteed, if you will, from a publisher or developer who's promising to pay you X amount by X date. What's the significance of that letter?
The opinion letter is because, as much as I'm sure you're all lovely people, if you come to me and tell me that your tax credit is going to be X, that's your opinion, and that's you as a producer. And let's face it, you might have ulterior motives in telling me your tax credit's at a certain level. Whereas by working with an accountant, a professional qualified accountant who owes us a duty of care, because obviously the third party element, then obviously they obviously can't do that. So I know that is what the tax credit is going to be. Not only do I know that, I have a professional opinion that says that. And if that figure was to be materially wrong, we could potentially go after the accountant for negligence, or potentially even try and get them struck off or something like that, which of course means that the accountant has a vested interest in only delivering very accurate opinion letters. And as I said, there's only about 8 or 9 firms that do this probably in the UK. And therefore, if they were found out to be doing, if one financier got burnt by an accountancy firm, no other financier would accept an opinion letter from that accountancy firm. So does that sort of answer your question in terms of the certainty it gives us? Of the tax credit. Yeah, it's the opinion of the spend that the company will be making and the tax credit that it will then incur. And the time frames in which that will happen as well, of course.
Great. Well, I think we're about there, aren't we? It's 12:45 lunchtime. Thank you very much, everybody.
Yeah, we'll be hanging around afterwards.
Come up and see us in person. Yeah.
Come and have a chat. Thank you.
Well done.
Yeah.